Just in, Canada has moved to seize US-linked mining assets after a high-stakes federal dispute, and the implications are far bigger than most headlines are letting on. This is not just about one industry. This is about power, leverage, and what happens when policy failures collide with national resources. How did it come to this? Why now? And what does this mean for American workers, investors, and global supply chains? Tonight, we break down three critical questions. First, what exactly happened behind closed doors that led to this unprecedented move? Second, how did years of regulatory conflict and diplomatic miscalculations set the stage for this moment? And third, what happens next, not just in Ottawa and Washington, but across global markets? Because this story isn't isolated, it's connected. And once you see the full picture, you'll understand why analysts are calling this a turning point. And it gets worse. Here's what we know so far. Canadian federal authorities initiated legal control over multiple mining operations tied to U.S. firms operating in resource-rich provinces following a prolonged regulatory dispute. According to official filings, the action centers on compliance failures, unresolved tax obligations, and environmental oversight conflicts. The affected assets include facilities in Ontario and Quebec, regions critical to North America's supply of nickel, lithium, and rare earth elements, materials essential for electric vehicles, defense manufacturing, and advanced technology. Government records show the disputed operations collectively represent billions of dollars in long-term projected output. Canadian officials point to repeated warnings issued over several years, citing missed deadlines and unresolved compliance reviews. U.S. stakeholders, meanwhile, argue that shifting regulatory frameworks and political pressure made compliance increasingly unworkable. Analysts say this standoff escalated after bilateral talks stalled. And here's where it becomes personal. One U.S. engineer who spent over a decade working at a Canadian mining site told reporters that employees were caught completely off guard. Families suddenly faced uncertainty. Projects paused overnight. "We thought negotiations were still happening," he said. "Then everything stopped." But here's the kicker. This isn't just a legal disagreement. It's a strategic conflict over resources that both countries desperately need. And when resource control becomes political, the consequences multiply fast. The materials at stake power the technologies defining the 21st century economy. Without them, electric vehicle production stalls. Defense systems face supply bottlenecks. Consumer electronics become more expensive and harder to manufacture. This seizure represents more than regulatory enforcement. It represents a fundamental shift in how allied nations approach resource security in an increasingly uncertain world. When neighbors start treating critical minerals as bargaining chips, the entire framework of North American economic integration comes under stress, and it gets worse. To understand why this matters, we need to break down the mechanics behind the seizure. At its core, this dispute revolves around jurisdiction, enforcement authority, and strategic resource policy. Canada maintains the legal right to regulate and, in extreme cases, assume control of assets that fail to meet federal standards. That authority exists on paper. What's unusual is how decisively it was exercised here. Experts note that the assets in question fall under enhanced review frameworks introduced after global supply chain vulnerabilities became impossible to ignore. The pandemic exposed how fragile international logistics had become. Semiconductor shortages crippled auto manufacturing. Medical supply chains buckled under demand. Governments worldwide began reassessing who controls critical materials. Canada was no exception. Data from industry reports show that over 60% of North America's refined nickel and lithium supply passes through Canadian operations at some stage. Any disruption sends immediate shockwaves downstream. Automakers feel it first, as battery production timelines extend. Defense contractors feel it next, as specialty alloys become harder to source. Technology manufacturers feel it third, as component costs escalate and availability narrows. So why escalate now? Analysts point to a convergence of pressures. First, demand has surged beyond all previous projections. The transition to electric vehicles accelerated faster than infrastructure could support. Second, regulatory patience has worn thin after years of what Ottawa views as inadequate responsiveness from U.S. operators. Third, geopolitical risk calculations have changed dramatically. When supply security becomes national security, tolerance for uncertainty shrinks to near zero. There's also precedent for this kind of assertive action. Canada took decisive steps to increase domestic control over energy assets amid global instability triggered by OPEC oil embargoes. That move reshaped investment flows for decades and redefined the relationship between foreign capital and Canadian natural resources. While this situation differs in scope and specific context, the underlying logic is remarkably similar. Secure control first, negotiate the details second. Think of it like a pressure valve on an industrial system. For years, pressure built quietly through compliance disputes, delayed permit approvals, and mounting policy friction between federal regulators and multinational operators. Small frustrations compounded, communication channels deteriorated, trust eroded incrementally. When the valve finally opened, it didn't release gently through managed negotiations. It snapped suddenly through enforcement action. But here's the critical cause and effect chain that few are discussing. Regulatory uncertainty discourages long-term investment. Discouraged investment slows compliance improvements and modernization efforts. Slower compliance invites stricter enforcement scrutiny. Enhanced enforcement triggers diplomatic fallout between allied governments, and diplomatic fallout reverberates unpredictably through financial markets. And it gets worse. Market data shows that within days of the announcement, mining-related equities tied to North American operations saw noticeable volatility, with some stocks declining by double-digit percentages in single trading sessions. Analysts flagged increased risk premiums almost immediately as portfolio managers reassessed exposure to cross-border resource operations. Investors hate uncertainty above almost everything else, and this situation is absolutely drenched in it. The broader question becomes, was this outcome inevitable or was it avoidable through better diplomacy? Experts remain sharply divided. Some argue that years of stalled negotiations and unresolved technical disputes left Ottawa with no practical alternative except decisive action. Others warn that aggressive enforcement without carefully synchronized diplomacy creates long-term damage to bilateral economic relationships that far exceeds any short-term regulatory gains. Either way, one message comes through with unmistakable clarity. Control over critical resources is no longer just an economic issue to be managed through market mechanisms. It's a strategic security imperative requiring government involvement at the highest levels, and that fundamental reframing changes everything about how these industries operate going forward. Let's break down who feels this first and hardest. American workers and families are standing at the front line of this disruption. In the Midwest, suppliers tied directly or indirectly to Canadian mining output face reduced orders almost immediately. One manufacturing technician in Michigan told local media that over time shifts vanished within a week of the announcement, cutting household income by nearly a quarter. In Nevada, a battery component facility flagged potential production slowdowns that could affect hundreds of employees. And in Texas, logistics firms began urgently reassessing cross-border shipping routes and contract obligations. Then there are small businesses caught in the crossfire. Consider a mid-sized equipment maintenance company that services mining operations across the Canadian border. With contracts suddenly frozen pending legal resolution, revenue projections collapse overnight. Payroll decisions get delayed or become painful. Expansion plans get shelved indefinitely. For small operators without deep cash reserves or diversified client bases, even short disruptions can prove existential. Large corporations aren't immune to these shockwaves either. Public SEC filings show several multinational firms issued formal risk disclosures following the seizure, explicitly warning investors of potential supply interruptions that could materially affect quarterly earnings. While diversified portfolios and multiple supplier relationships cushion the immediate blow, share prices still reflect heightened uncertainty. Capital doesn't wait patiently for clarity to emerge. It moves swiftly elsewhere toward more predictable opportunities. International partners are watching this situation develop with intense concern. European manufacturers dependent on North American raw materials are quietly adjusting procurement strategies and exploring alternatives. Asian buyers are accelerating conversations with suppliers in Australia, South America, and Africa. When reliability comes into serious question, commercial loyalty fades remarkably fast regardless of established relationships. Industry experts warn of cascading ripple effects across seemingly unrelated sectors. Energy transition timelines slip as battery production faces input uncertainties. Defense procurement costs rise as specialty material prices increase and availability narrows. Infrastructure projects face unexpected delays as supply chains reconfigure. One prominent analyst summed up the situation bluntly. Resource instability doesn't stay contained. It compounds exponentially across the entire interconnected economy. And there's a significant emotional and psychological toll that spreadsheets can't capture. Workers don't just lose overtime shifts or face temporary layoffs. They lose fundamental confidence in the stability of their industries and career paths. Communities built around stable, multi-generational mining operations feel profoundly shaken. Trust between employees, management, and government authorities erodes in ways that take years to rebuild. Anxiety rises not just about immediate paychecks, but about long-term prospects. But here's the real strategic danger that keeps policymakers awake at night. Once global supply chains fundamentally reconfigure in response to perceived instability, they don't easily snap back to previous patterns, even after disputes resolve. Temporary disruptions have a documented habit of becoming permanent structural shifts. New supplier relationships get established, alternative processing facilities get built, capital flows redirect. And that's precisely what policymakers on both sides of the border fear most, not the immediate disruption, but the permanent reconfiguration. So the critical question remains, who recalibrates first to prevent permanent damage? Governments through diplomatic resolution or markets through permanent restructuring? Because financial markets and supply chain managers won't wait indefinitely for political processes to catch up. Officials on both sides of the border are treading remarkably carefully with their public language, each word calibrated for multiple audiences. Canadian government representatives consistently emphasize lawful enforcement of existing regulations and protection of national interest. U.S. officials frame the move as concerning and disproportionate, but carefully maintain it remains under diplomatic review. Experienced analysts read carefully between these measured lines. One respected policy expert with decades of cross-border experience noted that this action signals a fundamentally harder edge in resource governance philosophy that extends well beyond this specific dispute. Another veteran observer warned that unresolved disputes of this magnitude and visibility could easily invite retaliatory measures that escalate tensions further. A third seasoned voice cautioned that prolonged uncertainty without clear resolution pathways risks chilling cross-border investment flows altogether, with consequences lasting far beyond this particular controversy. Legally, the situation enters genuinely complex territory without clear precedents. International arbitration pathways exist within NAFTA successor frameworks, but these processes typically take substantial time from initial filing to binding resolution. Politically, leaders on both sides face intense domestic pressure to appear strong and defend national interests without unnecessarily escalating bilateral tensions that could damage other aspects of the relationship. In the immediate next period, expect intense behind-the-scenes negotiations away from media attention. Temporary operating arrangements may emerge that allow partial resumption while disputes continue. Legal filings will multiply as both sides build formal cases. Financial markets will react sharply to every headline and rumor, creating additional pressure for quick resolution. Looking ahead, one particular scenario increasingly stands out to informed observers. If formal agreements continue to stall without meaningful progress, companies with capital allocation flexibility may begin permanently redirecting investment flows toward jurisdictions perceived as offering more regulatory predictability and political stability. That fundamental shift would comprehensively reshape North American resource dynamics and industrial geography long after this specific dispute finally fades from news cycle attention. The stakes genuinely couldn't be higher for the broader relationship. Resource policy, once considered technical and obscure territory for specialists, now sits squarely at the center of economic security debates at the highest levels of government. Every move is being closely watched, not just by directly affected parties, but by other resource-rich nations considering their own policy options. Because once control decisively shifts in disputes like this, strategic leverage naturally follows. And leverage, once established, rarely gets surrendered voluntarily. Let's recap the three critical takeaways from this developing situation. First, this seizure marks a genuinely significant escalation in how resource disputes get handled between even closely allied nations. Second, the ripple effects extend dramatically far beyond mining sector headlines, directly touching workers' livelihoods, business operations across multiple industries, and global supply chains. Third, the long-term outcome hinges entirely on whether diplomatic processes can keep pace with aggressive enforcement actions. Here's the bottom line. When nations begin treating critical resources as strategic leverage rather than commercial commodities, the fundamental economic rules change, and they change fast. So I'll leave you with this question. Does this moment signal a new era of resource nationalism reshaping the global economy, or is it a temporary shock that cooler heads and mutual interests will eventually resolve? If you want to stay consistently informed on stories the mainstream media won't fully cover or properly contextualize, make sure you're subscribed and hit the bell icon. Because in a world where policy decisions reshape livelihoods literally overnight, understanding the why behind events matters more than ever. Thank you for watching, and I'll see you in the next one.